For over half a decade, the global silver market has been defined by a deep structural crisis. Between 2021 and 2026, the metal experienced an unprecedented streak of consecutive annual supply deficits, drawing down cumulative above-ground inventories by roughly 800 million ounces. However, recent market data indicates a shifting narrative, as the annual silver supply deficit is finally beginning to narrow. This reduction in the deficit is not driven by a sudden, massive surge in mining output, but is instead the result of a complex interplay between technological adaptation, price-induced demand destruction, and the shifting dynamics of institutional investment across the global supply chain. Industrial applications account for more than half of global silver consumption, with the solar photovoltaic sector serving as the primary locomotive of demand. As silver prices climbed to historic highs, peaking at over $120 per ounce in early 2026, industrial manufacturers were forced to innovate rapidly to mitigate soaring costs. Solar panel manufacturers accelerated thrifting initiatives, drastically reducing the volume of silver paste required per individual cell. This aggressive reduction, alongside the partial substitution of silver with cheaper base metals like copper, has successfully flattened and reduced green energy silver demand, even as global solar installations continue to achieve record capacities. Beyond industrial engineering, the extreme price action triggered classic demand destruction in price-sensitive retail and consumer segments. Major consumer markets, particularly India and various Western nations, saw a sharp contraction in jewelry fabrication and silverware purchases as local currency prices hit prohibitive highs, while peripheral electronics manufacturers temporarily scaled back production or utilized alternative alloys. Simultaneously, the normalization of investment capital eased the immediate burden on physical supply. During the peak of the squeeze, aggressive accumulation of exchange-traded products, bars, and coins acted as a massive vacuum on physical metal. As the market stabilized later in 2026 and prices corrected to the mid to upper 80s range, speculative futures positioning pulled back and significant capital outflows occurred within silver ETFs, returning much-needed liquidity to the marketplace. This shifting landscape has created a unique paradox within the silver industry, where a dramatic contraction in the gap between supply and demand still leaves the market fundamentally undersupplied. During the peak deficit era of 2022 to 2024, the annual shortfall routinely exceeded 180 million ounces, whereas the projected deficit for 2026 has shrunk significantly to between 46 and 70 million ounces. Despite this massive reduction, the market remains in a net deficit, meaning that global supply is still failing to meet total demand. This persistent gap forces the market to continually erode what remains of historically low exchange inventories in London and COMEX vaults. The issue is further compounded because roughly 80% of silver is mined as a secondary byproduct of copper, zinc, lead, and gold operations, rendering primary mining supply highly inelastic and unable to quickly ramp up production based on silver prices alone. Ultimately, the reduction of the silver supply deficit highlights the market's capacity for self-regulation through technological agility and price elasticity. By finding ways to use less silver in green energy technologies and pulling back on luxury consumption, the global market has prevented a catastrophic physical shortage. However, because a structural shortfall still exists and above-ground buffers have been severely depleted by years of relentless undersupply, the silver market remains remarkably lean. The deficit may be shrinking, but the underlying fundamental tightness ensures that silver will remain highly sensitive to any future industrial or economic shocks. Like and subscribe. Reference Tube.